Welcome back to Yahoo Finance Live this morning, everyone. We're seeing some mixed activity across the major averages with the S&P 500 and the NASDAQ in negative territory. The Dow, though, holding on to some gains by about 117 points. We are 10 minutes into today's trading session. Let's get on over to Blikre live at the Wi-Fi Interactive. Jared?
Yes, a bit of a mixed market to start the week. And remember from last week, we started out pretty nicely and then ended up giving back most of those gains. Let's take a look at the sector action today, and we can see industrials in the lead, so cyclicals and the value stocks doing well. Energy also up nearly 1%, followed by utilities, financials, real estate, staples, all of those outperforming. In fact, the only things that are underperforming right now are these two sectors, which are in the red. That's consumer discretionary, which houses Amazon and a lot of those retail stocks, as well as tech stocks and chip stocks, as we've been talking about, have really been flagging. All right, here's our NASDAQ 100 board. We can see PayPal software stock down about 4%. It looks like there's a lot of weakness in the Chinese stocks as well. Pinduoduo down over 6%. Taking a look at some of the leaders here. In fact, let's take a look at our leaders sentiment board. We can see banks, those are regional banks. That is in the lead, up 0.9% as a yield curve expands. We'll talk about bonds in a second. Low volatility ETF, momentum ETF, retail, really kind of a mixed bag for what's in the green. Not seeing a lot of movement yet, so not putting too much emphasis. I mentioned Chinese stocks. KWEB, that's a Chinese internet ETF, that is down 4%, followed by SOX, that's the chip stock chip index, cannabis stocks, which saw a huge week last week on the Biden news, and then we have solar ETFs. All of those are in the red, but it looks like just kind of giving back some of those gains. And then for a look at what's really on the edge of the market here, meme stocks, that is a mixed board. GameStop up about 2%, guys.
Well, you did mention the bond market, which is closed today, by the way, because of the
Indigenous Peoples Day.
Yes, exactly. Although I think
FIC traders are very observant.
I'm sure that is exactly what they're thinking about today. And among the many entities and people who have suffered losses on their bond portfolios this year, we can now add the Federal Reserve to that list.
Yes, very interesting development. The Fed owns, $8-9 trillion worth of bonds, a rounding error perhaps, but this is a 5-year T-note yield. I'm going to go down to the 10. I tweeted some material about this. Now, Morgan Stanley has written this up. This has to do with the Fed's balance sheet. The H41, this tells you the position of each of the reserve banks as they feed into the Fed system. And here is a key line: earning remittances due to the U.S. Treasury, negative $2.9 million, $2.9 billion. So the Federal Reserve System banks are in debt, en hoc to the Treasury, where they send their profits every once in a while, periodically. And so this number is going to grow as the Fed continues to rein in through QT its bond purchases. This is something that Bernanke warned about in his last press conference. It didn't seem to matter back then, but this is Morgan Stanley just kind of writing a very brief summary of this. Remittances to the Treasury, and the Treasury issues more debt. The Fed then accumulates its losses, and rather than reducing its capital, creates a deferred asset. When earnings turn positive again, remittances stay at zero until the losses are recouped. This means that it's going to be some time from now before the Fed starts sending checks back to the U.S. government. It matters. This is $100 billion a year in a rising interest rate environment.
That is some top work there, my friend. Jared Blikre kicking off this week with a bang. Good stuff.